Well, starting this week, and it actually started last week, and I want to say scary feeling as opposed to scary actually. Hopefully that we can do just a little bit of damage to prices, but a whole lot of damage to people's confidence and get them all thinking that the sky is falling and we're all going to die, so we can get a nice bottom put in terms of sentiment. What I'm seeing, first of all, is a great leading indicator that I have shared with my subscribers for several years. It's based on some really wonky data coming out of the Commitment of Traders report. We look at the net position of the commercial traders of Fed funds futures, which is an interest rate product. And these data about what the commercial traders' positioning is as a group tends to give us about a 5-month leading indication of what the stock market's going to do. It's like the pig going through the python. You can see it making its progress. Well, if there's a fluctuation in the banking system that shows up in those Fed funds futures, it shows up 5 months later in the stock market, and it says that there's a dip coming right now. And by right now, you should understand these are weekly data, so it's not going to tell us exactly to the second. And lasting into the first part of April, we'll probably get all the damage done at the first part of it, and then wallow around in the bottom for a while, getting everybody upset and discouraged, and then should take off like a scalded dog as April unfolds. One other thing that I'm looking at for expecting a correction right now is some work done by my friend Rob Hanna from Quantifiable Edges. He notes that the week after March expiration, which was just last week, that's down 3/4 of the time, 3 times out of 4. So you really have to be fighting hard against seasonal tendencies to get an up week this week.
So when you talk about the market and make a call like this, Tom, are you talking about the S&P 500? Because lately it's been a tale of two markets. There's the NASDAQ and there's the cyclical groups, which you can see in the discrepancy between the Dow and the NASDAQ, which has already had a correction off these higher rates fears. What are you making a call on?
That's very true what you're observing, that lately it's been a lot more different among the major averages. You'll get the Dow going one way and the NASDAQ 100 going the other way, and then they'll flip rolls the next day. Today, the big cap tech is up, but the Russell was down, and breadth is not that great. So it's unusual to see the market getting this kind of differentiated, and it's actually a sign of illiquidity that the limited amount of money that there is to go chasing cannot chase everything all at once. So it goes in very narrow directions. I'm expecting that liquidity to remain with us into early April, that illiquidity. And then it should start roaring back as all of the stimulus goes to work and all the Fed money printing at $150 billion a month continues to go to work. We're just having a normal seasonal interruption. I will note, however, that one factor affecting liquidity is as people start going back to work, going back to restaurants and shopping malls and going out and doing things, that money that they might be spending in the stock market because they got nothing else to do, they got something better to do with it. So that's going to create a little bit of a liquidity drain, but only temporarily.
Tom, you've also been looking at rates, where you expect them to go, and the relationship between rates and gold.
And it's an interesting relationship. People look at them most often coincidentally, and that's how I started looking at it early in my career. But I realized that interest rates get a message from gold. Gold seems to know what's coming well in advance. It knows what grain prices are going to do about 15 months in advance. It knows what interest rates are going to do about a little over 20 months in advance. And so I sent you a chart comparing near-month gold futures prices shifted forward in the chart by 20.5 months to show how the same movements that gold prices sees get echoed, the same dance steps get echoed in long-term interest rates. So in that chart is the Treasury Yield Index, which is the current yield to maturity on the most recently issued 30-year Treasury bond. It echoes the dance steps in gold 20 months later, and gold had a big run up out of its 2018 bottom that interest rates are just now echoing. And the point is that gold had run a lot further from this point that we're echoing now. We're just now to the point where gold was $1,500 an ounce, and you may remember that gold zoomed all the way up to above 2,000. So long-term interest rates have a lot further to go. They're going to peak out initially about mid-May of this year and take a rest break for the rest of the summer, bottoming late August to early September, and then start another big powerful surge upward. So if you haven't refinanced your mortgage already, I feel bad for you, but there is long-term rate hikes are still coming. We're going to get a rest break in May, but it'll only be a temporary one.
Shepard Smith here. Thanks for watching CNBC on YouTube.